all over the news lately. There have been stories of bank crises, even a few banks failing. But on the minds of everyday people are real life problems. So today I wanted to explain to you exactly what's going on with the bank, with the financial markets, with the government, and what you should be thinking about and where you probably want to keep your money. So stick around, you're not going to want to miss this. I'm Rich Smith, and one of the money lessons you never learn in schools is how the modern day banking system works. There are news stories about bank failures in America right now, big ones. Probably not the ones where you were keeping your money though, so don't be alarmed. Don't be like running to the bank right now and taking everything out and stuffing it in the mattress. But let's be honest, there's probably some things that you should be made aware of and keep on the forefront of your mind for the next few weeks or months, or just plain learn in general and just always keep in the back burner. So I'm going to dive into all the details, but right now, take a second, hit that like button. Really appreciate it. So there's two ways I could answer this banking crisis question, like what is it and why it's happening? Well, what is it is that the banks don't have enough money if everybody goes to the bank and takes out their money. So they have a liquidity problem and they're like, okay, well, maybe they can raise some more funds or sell off some assets. But if they are completely like in the red, insolvent, then the bank fails. So that's like what happens, but why it happens is because of something known as a bank run. Literally, like think back to the Great Depression times, everybody runs to the bank, they hear the bank, they don't have all the money, and they run to get their money out first so they're not left holding the bag. So you might be saying to yourself, is that real? Like, do all these banks really not have your money? Now, I want to tell you, when we're talking about, checking and savings accounts, like the answer is yes. They do not need to actually keep your money there in the bank. But of course, you might be thinking to yourself, well, Rich, they have it in a bank somewhere, like a vault. It's in reserves. And I'm telling you, they don't. The national banking system, according to like the Federal Reserve, they only need to keep 10% of all the money on the books in reserves. So yeah, it is very possible for a bank to go under if they are making investments with that other 90% that have high risk. They turn out to be like bad investments, or maybe somebody's just asleep at the wheel and they can't get all that money back when and if people actually want to take out some money. So if you're scratching your head saying, well, why are they, number one, allowed to do that? And then number two, why would they do that? It's all about profitability. If they can take 90% of the money and go and lend it out to somebody that then is going to pay them interest, they're getting the principal back and making interest. And then when they get that principal back, then they can loan that out again. And it's just this big ecosystem of working off of about at least 10% of reserves. Now, I don't want to be spreading fear here. There's no contagion right now. That's that word that basically means like everything's spreading, something bad's happening. But you do need to like be aware of what's going on. You see, one of the reasons that you can kind of like pump the brakes in terms of the fear levels is that the federal government, the FDIC, does insure your money at a bank. Like let's say you have one account, or even if you have, I'm not going to get into that, but the FDIC can insure your money up to $250,000. So if the bank ever had an issue and you're keeping $250,000, we're talking like cash in the bank, the federal government will insure that and make sure they'll make you whole. For example, maybe you got some inheritance, you sold some property, maybe you're a business owner and you just have a lot of money on hand. Well, it might be a smart idea to have more than one bank account if you're truly talking about having hundreds of thousands of dollars, in just one account. Okay, so big picture, key takeaways. I wanted to keep this a short, sweet, simple video for everyday people. To my firefighters out there, to my teachers, to my doctors who don't have time to stop focusing on their everyday jobs that are helping other people and go learn why some bank in Silicon Valley, went under. The reason that you probably could guess is because they weren't making smart investments with the money that they had. They were making predictions about the future that didn't come true. They weren't spreading things out and making things diversified. You know how to be smart with your money. We're talking like the basics at least. But sometimes, profit and what a quarterly report looks like for a business would end up influencing that business's strategy for the upcoming quarters. And, basically a perfect storm happened for not only a few banks here in the United States, but actually internationally as well. Unless you have more than $250,000 in any one account, then your money is most likely safe, especially if it's with one of the larger banks. Think of the ones that are nationally known like Wells Fargo, Chase, Bank of America. If you're worried about any bank, I would call them right now, ask them if they indeed have FDIC insurance, and ask a couple other probing questions. Find out how healthy they are. It's your money. If they can't answer your questions, then you have the right to take it out and go put it somewhere else. Oh, and real quick, I did want to talk about, I don't think I'm going to do a whole video on it. That's why I'll mention it here at the end. Your money that is in brokerage accounts, like investments. If you have money outside of the bank, there is also something known as FDIC insurance. So up to a certain amount, I think at the time of this recording, it's $500,000 for your investment account. If you have it at a brokerage firm, like for me at Vanguard or Fidelity, then that money is also insured. I want to point out that they're not allowed to take your money and go and lend it out in the same way a bank can. It doesn't work like that. Don't get me wrong, some of these investment firms have subsidiaries that are banks, so it can get real confusing. This has FDIC insurance, the investments up here have SPIC insurance. But anyway, if you're a multimillionaire, it's going to be a good idea to check in on all your accounts. If you're someone who has, a few $100K in investments, we're talking retirement investments, so long as it's under that $500,000 amount total, then you should be pretty good. Tell you what I'm going to do though, I'm going to leave a link down below in the description to a FDIC webpage so that you could type in, like the name of your actual bank and see how much you'd be insured up to. Maybe that'll help a few people if they're concerned if their bank is properly covered. Also, my website is full of information. I try to hit on these topics that as they pop up, but I'm not that flash in the pan, knee-jerk kind of guy. I want to sort of see how things are rolling out and playing, after a few days or weeks, and then give you all the information in a way that you can digest it and share it with someone else. So leave me a comment down below if you do have any of those questions. And if you're new to the channel, don't forget to hit subscribe and ring that notification bell. All right, as always, I'm Rich, and until next time.